Good afternoon. Good afternoon, everyone. I'm Baggett on at Stock Market Caddy, and today is December 23rd. Now, we're going to go radio silent on Christmas Eve, but it's not Christmas Eve yet. It's only the 23rd. So the markets are still open, and when the markets are open, there is opportunity. Let's take a look at Swing Machine. We're looking at the daily S&P cash. The daily Swing Machine is long. It's been long for 49 days. It's delivered 262 points. The trend is very strong, no question about it. Now, what it's showing us though, the mean, the access mean is 46.49. We're a good 100 points over that. We're really pushing up into euphoria on the greed and fear index here, if you will, in the gauge. So what I'm thinking is while we're up here at 46.34, I'm looking out not over the next few minutes, not over the next few days, but I'm looking out over the next 30 days. And I think that the markets are not likely to sit here. They're either, in my view, going to blow up higher, maybe by as many as 100 points, and or fall by maybe more than 100. But I don't think they can sit here. But I don't want to commit a tremendous amount of money. Let's get this positioned here, right, so we can see this. And get short the market and risk some sort of, capitulation squeeze. And I don't want to, commit long the money and wake up to a debacle, one morning, maybe as early as next week. So I will go into the options market. And what I'm going to do is I'm going to price out what is called a strangle. I'm going to look at a call option whereby I buy a call option basically where it's trading at about 47.30, maybe 35, we'll see, and then turn around and also buy a 47.35, 47.30 put, and I strangle it. Now, I'm going to have to dish out quite a bit of money to do that. And let's find out just exactly what that's going to cost and decide whether or not that's something we want to do. So we're going to come here, and I need to come here to my option chain, and we're on the SPX. And so I want to come out about 32 days. Maybe this will take us out to January. Let's go 36 days, right? So with options, I'm thinking I don't want to go, I don't want to go out months, but I don't want to go out just a few days. When we're trading intraday, we're trading with surgical precision. It's kind of like spearfishing. But with options, I make this comparison a lot. It's kind of like taking a crab pot and throwing it over the side of the boat and letting it soak for a few days or maybe a few weeks. If I buy these options, I got 36 days. I would hope to be profitable by half. If I get 18 days into this, then and I'm not profitable, then I'll probably close it. But let's go take a look and see. Let me show you what we're thinking about doing here. We'll go through the mechanics. So I need to find. So I'm in the January 22nd, and we're currently trading at 47.34. So I got to come down here and find the strike. Here's the strike column. And so I want to come here, and let's just take a look at this. I want to get, all right, so I can get a 47.35 call option. And let's see, if I were to buy, see, I don't want to sell it. I would want to buy it. Let's it would be right here. Buy. It would cost me $8,200, which would be $8,000. And if I wanted to buy, so that would be a long bet, right? So it would have to go up another 80 points for me to get in the money. If I come over here and I buy a put, Notice the put's always a little bit more. The put would be 8,400. I would, in essence, strangle 47.35. It would cost me $16,000. 16,000. So I would have to come down. I've got to move 160 points, which I think is very doable. I think so, more so on the downside. That would be a strangle. More I think about it, that's a little bit more money than I want to be able to put on. So I'm going to take a directional bias. I think it's more likely over the next 32 days that we're going to be down than up. I could be wrong, but I think that's what I'm thinking because of where we are. We've bounced on white volume. It's the holidays. Everybody's, we're back up to these highs. The overall breadth of the market is weak. There's a whole lot of indications that this is not sustainable. They can't. One thing to make new highs, nothing to hold it. So what I could do is I could buy this put for 84. We're trading at 47.35. So I'm going to do that. I'm going to click on this. And I'm going to buy. I don't want 5 of them. I only want 1. And I want to put it in as a market order. So it goes right in. And it's probably a good idea to do it as a limit, but I'm going to put this in. I want this to go right in. And I'm I'm buying 1 SPXW.X, expiration January 28, strike 47.35. What type of option? A put option. It needs to go down for me to make money, in essence. So let's place the order. It's going to cost me $8,400. And let's it should be in there. I didn't hear it in my headphones. Let's go look. There it is. Okay, that took a little while. All right, so there's the trade. There it is. And this is the option. We can open this up. There's the option. I bought a January 47.35 put. It's good for 36 days. That's my open P&L. My trade cost is $8,840. That's my maximum risk. If, as we go, if we stay above 47.35, then I will lose that money by that date. I've got to come down, and I've got to come down enough and fast enough to cover the cost of the trade. But one of the things that I could do is I could offset that cost. And I'm thinking that if we sell down, I'm going to get out my calculator in January. I'm thinking that we could come down as much as 10%. How much would that be? Well, if we're at 47.35, 10%, that would take us down to about 4,300. So what I could do to offset my cost, let's go look here. I could come to 4,300. Let's think about this. That would be, well, let's just find out exactly. Let's just take 10% off. We're at 47. We're doing this longhand here right in front of you, times, that would take us down to 4,260. So 4,300 would be a 10% move. Maybe we shouldn't be so greedy. How about we take it down to 43.35? So what I want to do here is I want to sell. I'm going to sell a 43.40. I'm going to sell a put. In this instance, I'm going to receive approximately $20, which would be $2,000. Let me show you. So we're going to come in here. There's the sell. I don't want 5. I don't know why my default. I only want 1. And I'm going to put it in as a market, so it goes right in. And in this instance, I'm selling 1 quantity, SPX for January, this S&P cash for January 28th. The strike is 43.40, and I'm selling a put. it obligates me to buy the market at 43.40. But Don, what if it goes below that? That's a huge risk. Well, it would if it was naked, but it isn't naked because my put that's higher will be making money. So basically what I'm trying to do is I'm making a directional bet between where it is now, 47.35, and 43.40. So that naked, that I would have the entire risk, but that isn't the case. And my max profit is 2,000. So let me show you what this looks like. We're going to place the order, and there we go. So now we go to the manage, and what have we done? This is the call that we bought. I'm sorry, put 47.35, 8,840. Then I sold a put at 43.40. Same time frame. I received a credit. So that means my total cost is not 8,000, it's only 6,000. And what in essence have I done? I'm going to click on this. It's the neat thing about TradeStation. I'm going to drop it right on top. I created a vertical put spread, a 47.35, 43.40 put for 36 days. My maximum cost on this is 6,480. That's my maximum, not my maximum cost. That is my maximum cost. It's also my maximum risk. What is my maximum gain? Let's take a look at that. Okay, so I'm going to need to reset my TradeStation Option Pro to have the column, but we can calculate in our heads what the max gain is. The max gain is the difference. You take 47.35 minus 43.40 is about 395 points times 100. So that would be, if we trade below 43.40 by January 28th, that would be 39,500. However, I had to outlay 6,480 for this opportunity, so my net would be 33,000. That is my maximum gain. So my maximum risk is 6,480. My maximum gain is 33,000. Those of you that like profit factor, that gives me a risk factor of like 5 to 1. That's very, very attractive to me. When I put on these puts or calls on the S&P, I'm not just putting them on just to make a little bit of money. I'm thinking that I've got a shot of doubling my money. So I would actually be happy. I mean, 33,000 would be very much an outlier and would be wonderful, but I'm not banking on that. I think I've got a really good shot, though, of turning $6,480, my risk, into a $6,500 profit, which would be a 100% return on that. That's what I'm thinking. Now, if the market continues to run, then that won't be the case. I would have that at risk. I might be able to, on this 43.40, I might be able to reposition that, though. So by doing a vertical put spread, it gives me a little bit more flexibility to work with this option should the market continue to melt up today and into next week. Good luck, everybody. And if you have any questions or you're wondering what we're doing, feel free. We come back here to this tool, and it's this tool that is telling us what we might want to be doing. And we're not suggesting that you do this. We're not suggesting that anybody do this. We're about, trading one's own game. And Susan has her game, my wife Susan, and I have my own. But that's what I like to do. I'd like to get it right up in here, but I'm thinking maybe now is the time. Good luck, everybody. I'm Bag It On. Be sure to visit stockmarketcaddy.com and/or feel free to give us a shout at 813-758-8263. And while we're here, let's just take a look at the markets right now. On a 5-minute interval at 9:35 this morning, swing machine does what? It goes long. 5-minute, you'll be up 1,000. 9:35, the NQ goes long, 2,500. YM, market goes long at 935, you're up 700, and the Russell 1045. If you're thinking, what the hell is that all about? 935, 935, 935. That, folks, is not a coinky dink. That is machine trading. Good luck. Not by we are machine traders, but that is the big boys. That's their machines. These markets are moving up and down by machines. Give us a shout.